All right, I think we should get started. This is a webinar organized by DD Shares. Welcome, everyone. My name is Claus. I'm the CEO of DD Shares. I'll be the host here today. I'm happy to see the speakers and the participants in the webinar. We'll go forward pretty soon. So we'll be focused on tokenization in Southeast Asia. We have got some great speakers for you. First off, Arvinder Sood from Hanover Square Investments in a few minutes. Then we are going to hear from Pooja Sinha, head of international finance in L&Y Law LLC, lawyer in Singapore, and then Henry Yu from L&Y Law Office, lawyer in Hong Kong, Joe Lin from Citadao, and finally Chris Tran from the U2U Foundation. And then at the end, we'll have a fireside chat and a panel discussion, and we can ask some questions and hopefully get an interesting discussion going. We're using Zoom for this. There's a Q&A function, so if you have questions, please put them into the Q&A, and I will make sure that they get asked. It's also possible for you speakers to actually, so if there is a question that is directed for you that you feel is better to just correspond to in writing, you can do that within the Q&A function as well. But otherwise, I think it's best to have it out verbally so we can get everyone to hear it. That's basically, I think, the practical remarks that I want to make before we start. Tomorrow we have a webinar on tokenization in Africa, also with some interesting speakers. Next week we are doing a webinar on the exchange we are launching in a few months, Real Estate.exchange or REX. You can see information about these on our website and also on LinkedIn. About DD Shares, we are seeing a pickup in business globally at this moment. A little bit in the US, but even more in Southeast Asia and Dubai, the Middle East. Last week I was in Korea to participate in the first tokenization event in the country actually ever, the STO Summit in Seoul, where I did a lecture. But we have also we're going to publish today or tomorrow on LinkedIn. Next week I'm going to Dubai to do a masterclass at the World Token Summit. Especially in both places, we see a lot of interest. The regulators are very positive, opening up towards tokenization, and we see a lot of interest from local companies to start POCs in the tokenization space. I think that's enough of an update from my side. Then I think we will get to the first presentation of the day, which is from Arvinder Sood from Hanover Square Investments. Mr. Sood was instrumental in starting businesses and managing them in institutions. His last position as managing director at Tokyo Mitsubishi International, he was entrusted with 1.4 billion notional risk book to trade asset swaps, credit derivatives, structured MTNs, and bond repackages. After leaving Mitsubishi, he was asked to manage a fund for a Japanese institutional client together with his colleague, Mr. Sugui Wakabayashi. 170 million fund invested in liquid and illiquid fixed income and credit-based assets as required by the client, delivered 9.43% annualized return with a Sharpe ratio of 1.32 over the life of the mandate. He also was a limited partner in a venture capital fund in Silicon Valley, along with other US-based private equity and venture investors. He advises industrial families in Europe on the growth of their businesses. And he has recently completed several debt and equity financing of mid-cap Asia oil and gas engineering services company. And he has built a specialized know-how in intermediate metals used by semiconductor and aerospace and satellites companies. So I welcome Avi as the first speaker. And let's get started. You can kick it off. I have your presentation. I will share it, and you can just
thank you.
You can just tell me when to.
Okay, why don't you? Okay, so first of all, thank you very much, Claus, for the kind introduction. And I think you made a very relevant point about in advising clients on advanced scientific materials. So it's always helpful to give context to our own case of trying to use the tokenization of the digital security market as a means of raising capital against a business that is being set up in Singapore, which is backed by the underlying intermediate metal. It's not a mine, it's not an ore, it's actually fully refined, processed material, which when converted into, next slide, next two slides, skip the, Claus, can you skip the disclaimer, please, and go on to slide that provides the background. Next, yeah, next one, yeah, okay. So we have, as Claus mentioned, we advise an industrial family in Europe. They have a whole range of industrial materials, scandium, titanium, rare earth elements, and including pure nickel wire. Nickel as a asset or as a material has unique properties, and we took upon ourselves to have those properties verified. We did quite a bit of R&D work with the two research universities, one in India, one in Singapore, and through two very eminent, well-regarded material scientists. And the sum and substance, the outcome of that was, one, a clear establishment of the properties of the underlying, besides its commercial value, which was independently affirmed by one of the big four accounting firms, okay? And we then sent samples of this material to a lab in America called Electromechanical Design Company in Chantilly, Virginia. And their significance is that they do a lot of R&D work and via calibration and certification for NASA on their space program, because obviously any cabling that is put into satellites can't fail. You see, failure is not an option, as they say. And similarly, the Jet Propulsion Laboratory at Caltech also uses them to have the certified. So we did that. And so our then plan was to see how do we raise capital to finance this business. Obviously, there's a conventional venture capital route, and there is also the token route. And the token route became quite appealing to us, and thus the basis of my dialogue with Claus, because of their technology and their SaaS capacity to support businesses like ours. So the first and foremost step was, just by way of my own background, I spent a greater part of my career in New York and London in the securities markets. So I have a very good sort of securities markets background. And I know that things under SEC and under the UK regulation regimes, what is feasible, what isn't feasible. And so I spent a great bulk of my time actually working with a Singaporean law firm, trying to get my grip and arms around structurally what is feasible. Next slide, please, Claus. Yeah, so we completed the underlying asset value. We identified the market. So we had a very strong business case to do the tokenization structurally, asset value wise. So we had a very clear idea as to why it should be successful and attractive to the investors. And so our initial approach was that we would work with a recognized market operator in Singapore, regulated, licensed by the MAS, and then issue securities tokens on that exchange. Well, little did we know, of course, fundamental to any offering that we, as a matter of governance course, is to get a tax advice, speak to tax lawyers and tax accountants and get a clear idea. And so we discovered quite a few things, okay? The whole idea somebody suggested to us, well, why don't you tokenize a profit participation in contract or economic interest contract? And the reality is, I must share with the participants in this panel and also in this webinar, is that it is not quite clear, much to MAS's credit, that they want to make Singapore as the hub for digital securities and crypto, etc. But the reality is that the legal framework, the tax code, needs to be modernized, which I'll come to you in a moment to explain the structural barriers at the moment to doing a tokenization out of Singapore, and I'll conclude why we ended up being where we are today. Claus, next slide, please. Yeah, so very simply, Pooja, you would appreciate it. Limited partnership structure, very efficient in Singapore. The metal owner and we as the services provider, just our affiliate in the UK is FCA regulated, and we are not regulated in Singapore, but we have a non-financial affiliate here that does a lot of sort of research work and also structuring work out of here. Would set up a new co, and it would basically in turn to drive this token issuance, will also sort of apply for as a general partner pool operator, for the limited partnership structure, appoint a manager to provide services to the GP pool operator, and then to complete the cycle for the initial issuance or the setting up of the LP structure, we would have the initial limited partner, okay, to do that. So we went through that exercise in compliance with Singapore law. Next slide, please. So the fly in the ointment for the structure was that for tokens to officially trade on the exchange, Singapore's law still requires a deed to be sealed, except in the case of Singapore companies, of course, you see, as Pooja, you would know. But Singapore law deeds need to be executed in wet ink, and so physically delivered. So this makes the whole notion, the idea of any scheme to be digitally traded as a limited partnership under Singapore until law is modernized to be very difficult. However, having said that, Joel, we have learned that in Hong Kong, real estate appears to have been successfully tokenized using limited partnership in Hong Kong. And I'd like to hear from you as to the structural changes that Hong Kong regulatory authority and the tax authorities have adopted to facilitate that. Next slide, please. So the next structure we explored in quite detail, and we're engaged quite extensively with Enterprise Singapore that oversees. Why Enterprise Singapore, not MAS? For the very simple reason that the underlying is a metal, okay? It's a industrial metal, and therefore we fell in that bucket. So under the CTA, Commodity Traders Act of 1992, so we had to discuss with them, engage with them as to what we were trying to do. The basic structure was that our sponsor would make an in-kind contribution of nickel, and in exchange we'll receive, since we'll be not tapping into public funds, okay? That was the idea, okay? And so to avoid being regulated and to get the exemption, we opted the in-kind contribution of metal from the sponsor, and the sponsor would receive tokens, and then he would also, the sponsor in turn, guarantee, as we call credit support, to the trustee manager in Singapore for those tokens to be listed and traded on a licensed regulated platform. They would undertake to cover the ongoing costs, and the valuation would be the equivalent of the net asset value of the underlying value, because obviously there'll be running costs, the cost of a trust structure, the cost of paying the auditors, the cost of operating just the trust structure entity in and of itself. So that would then get reflected in there. However, next slide, please. Yeah, the drawback with the structure we discovered was, and our idea was that we could structure it as a profit participating loan, and then we found that obviously there's a need. This is not a business trust, okay, and trusts are not familiar to various investors, although the units are typically issued, but instead of issuing units of a trust, here the idea was to have the trust issue tokens, digital security tokens. So the problem with the trust structure is that in any liquidation, there are complicated unwind situation in Singapore, and the Singapore does not recognize trust as a separate legal entity. So from that perspective, it would be, in our view, we thought might not be that appealing. Next slide, please. So that led us to rethink. We went to our drawing board and began to explore, and that's where my dear friend Claus came very helpful. We spoke to each other. We also spoke to someone that we both know in London as well. The problem with the UK is that UK under the new crypto regime has made it we are licensed in the UK, but we have to apply to get a new license, okay? It's not a new permission, but new license, as it were, to essentially address the whole AML regime. And they made it virtually impossible to do any crypto or STO transactions at the moment out of the UK. So UK became less of an attractive place for us, although it was logically the right choice for us, given the fact that we have presence there. So Claus and I began talking about it, and we discussed the most efficient way of doing it. And he said, Avi, Delaware, my friend, Delaware, my friend. And so the basic idea there is simple. The sponsor will make an in-kind contribution, to GTX. GTX is the Singapore entity that stands for Green Transitional Metals, that has been formed, and it's work in progress as we speak. It in turn will have a management services agreement with Hanover Square Investments Private Limited, of which I'm a director, managing director, and based in Singapore. And it will then in turn issue preferred shares to Delaware Holdco. And the reason to have a Delaware Holdco, which will be the issuing vehicle on an exchange for secondary trading, such as INX, which is regulated and registered with the Securities and Exchange Commission of the United States. And it'll then in turn trade in the secondary market with the STO investors under Reg D and Reg S. Under Reg D pertains to the accredited investors in the United States, and under Reg S, obviously across the globe. And to us, based on the legal advice we have received from a US counsel, that this is a far more efficient structure than trying to find alternative places, jurisdictions. Sadly, for me, my ambitions and my dream was to do something out of Singapore, out of a Singapore exchange, but sadly not to be. Hong Kong is an option, which we are also looking at it. But I think in the end, based on the appetite for our particularly line of business, that has a lot of appeal in Silicon Valley and in other places, that we found that the Reg D and the Reg S structure from a Delaware Holdco, it seems to be a very efficient way of issuing tokens, and also a lot cheaper, frankly. The other point I want to emphasize is that the holdco structure is also regulatory-wise quite efficient, because holding companies are exempt from regulations, okay? And the holdco will in turn be owned by the sponsor, and Hanover UK will provide arm's length services to the Delaware Holdco. So structurally, there'll be one common share held by the sponsor, and then there'll be Series 2, which will be the participating pref shares issued to the sponsor in exchange for in-kind contribution at the GTX level. And in this case, the value is say circa 200 million, and we're raising only 50 million, which is, by the way, I have to say at the moment, is a very big size. The amounts that have been raised in the STO market of late to date have been smaller amounts. Though that said, INX by themselves, as the sponsors of INX in the United States, it took them circa, I think, 14 months or thereabouts or longer to raise $83 or $84 million from institutions, from investors under Reg S offshore. Okay, so they've done this part. So we are, reviewing as to if tokenization path is to be run parallelly with a certificated Series A type of offering for green transitional metals. But that's the sort of the plans we are looking at. So next slide, please. So the other point I would like to sort of share with you is when we spoke to Deloitte in Singapore and Grant Thornton separately, the problem on distribute, one of the exchanges here, which are nameless, suggested, you can have an economic interest contract to represent by tokens. Well, that's well and good, but when we pressed and we asked a tax advisor that particular query, it became quite apparent to us that there is absolutely zero sympathy with the Inland Revenue Authority of Singapore in regard to either there are dividends or there's interest, okay, and on hybrid securities, unless it's declared as a share, there's just no way they're going to let you take advantage of that. But if it's treated as a share, the disadvantage of that in Singapore is there's a 0.2% stamp duty. So imagine if you're trying to run volume trading of digital tokens in Singapore, I think it's a disadvantage. Whereas in the United States, there's no such thing, as I understand it. And also the other problem is 50 holders. Okay, if you have more than 50 holders, then it's a problem. To address that issue, we thought of setting up a depository and a separate custodian, obviously, and the warehouse where the material is held as a sub-custodian. The idea of depository was basically it'll be a single investor and they could make the changes, okay, when the shares transferred. So that's, in a summary, having done quite a bit of work on this. So in light of all these constraints of structure using Singapore operating company, the Delaware holding company has become owned by a holding company in Delaware, a very attractive option for us. Thank you.
Thank you very much, Avi, for a great presentation. You have really been digging deep into the jurisdictional question, and I think that this is going to be really important knowledge for many people here on the call, and also people who will listen to the recording later on. And I'm looking forward to hear Pooja comment on it. Let me just see. So yeah, to the people coming in, we are doing the webinar on tokenization in Southeast Africa, America. On Southeast Asia. And we just completed the first presentation. We're going now to the second presentation from Pooja Sinha, Head of International Finance, L&Y Law, LLC. She's qualified in England and Wales and India. Extensive experience with leading international firms, including Clifford Chance, Linklaters, O'Melveny, and Myers. Pooja has worked in London and Singapore and brings deep expertise in cross-border debt and equity capital market issuances, debt financings, and debt restructuring deals. She has helped multinational and regional corporates, bulge bracket investment banks, funds, and financial intermediaries in Europe, Asia, and the US raise and restructure billions in capital, and has been recognized in the International Financial Law Review, in India Business Law Journal, and Chambers Asia for her capital markets and debt restructuring work. She has also recently advised on various deals at the intersection of finance and technology, including blockchain, digital asset, and tokenization related matters. So before Pooja starts, I can repeat again. So if you have questions specifically to the speaker, the current speaker, you can put them into the Q&A, and I'll make sure that they get asked at the end. Otherwise, there will also be a panel discussion at the end where we can take sort of general questions. So Pooja, please go ahead.
Thanks, Claus, for that introduction and for inviting me to this panel. It's very interesting to hear Arvinder go through the whole life cycle of figuring out, Singapore as a token issuance destination. I think Claus and you and I have, of course, had sort of, separate sidebars on that. It is indeed more challenging than it appears to be. But I would say that's the case with most tokenizations generally as well. As I said in my LinkedIn post, if I had, a penny for every time I was asked the how-to question on tokenization, I would be probably a multi-millionaire by now. But I think, what I found is that issuers, deal parties, I think just frequently sort of underestimate the complexities of tokenization. Of course, not you, Arvinder. I think you kind of went in there all arm, but I think even then you realize sort of how convoluted it could be. So I think, just kind of taking a step back, this presentation is covering, pretty much all the questions that I've been asked many times over the last 2 years on tokenizations. I think most deal parties are surprised to even realize that, they are doing something cross-border to begin with. They're like, oh, we're based here and our asset is based here, and our issuing company is going to be based here. So why do we even need to worry about kind of cross-border aspects? Why do we even need to get support from an international lawyer? And I think the misunderstanding is that unfortunately, international capital markets law is written and designed to have an extraterritorial effect. Of course, you have countries like the US where it's got kind of a super extraterritorial effect, and pretty much every single capital markets deal that you do in the world should include the Reg S disclaimer that Arvinder talked about before as well. But the US is not the only country with those kind of laws. And I think in Asia, where it does, of course, become particularly challenging is that, unlike Europe, as an example, we don't obviously have the benefit of a passporting regime or similar. So you do kind of have to drill down and look at the local law nuances in a number of different countries to get a deal across the line. So I think let me just dive into some specifics here. So the first part, I'll just briefly kind of touch upon, what is the cross-border regulatory framework that you need to be aware of? And of course, how you actually address that in the context of a particular deal requires more of a deep dive, similar to what Arvinder just did. So if you were to do an asset-linked token, of course, this is a highly simplistic, highly general structure. You would have kind of the entity which owns the asset. You would have the entity which issues the tokens. They may not necessarily need to be different entities. They could be the same entity. The relationship between entity 1 and 2 could be one of ownership. It could be one of contractual arrangements. The rights that the token holders have, of course, could be either just pure economic, or they could be, something more funky as well. So there's kind of various ways that you could sort of slice and dice an actual deal. But I think the important thing to bear in mind is that in this kind of scenario, you could have the asset in a different place, you could have the entity in a different place, and you will very likely almost always have the token holders in a different place. So in that context, one of the first things that you would need to figure out is, which countries do you need to be concerned about? So the location the countries whose laws you need to consider would depend on the location of your investors, your asset, your issuing vehicle, and also the location of the actual deal principals and intermediaries, because the kind of the brains behind the operation does matter from a securities and asset management perspective, which is, I think, something that often gets missed in the analysis that is done on these deals. So cross-border tax regulation, I think it's interesting that Arvinder talked about that at some length. I think that's another aspect. I mean, that's a whole sort of big rabbit hole in itself. But one is that particularly if you're using sort of assets which are in a different location and sort of housing the economic interests in an entity which is in another location, that by itself can trigger tax transfer pricing regulations. In addition to the fact that, as Arvinder talked about, the tax laws haven't always kind of kept up to speed with other changes in regulation. So even if you do have a very funky structure, you might find that you may not necessarily have all the tax benefits that you thought you would. And I'll touch briefly upon that in a different context just a little bit later on as well. Then you need to just kind of drill down into, okay, which countries you need to worry about, but then what sorts of laws you need to worry about. So again, taking a step back, the obvious one, of course, is securities laws. You obviously want to avoid doing a public offer. I think because a public offer, I think just taking a step back, is like doing a full-blown IPO, right? You have to kind of go through rounds and rounds of comments and process with the regulators. It's expensive, it's onerous, and all of that. So everybody is trying to fall into the private placement exemption. But I think the private placement exemption is not as simple as it might seem, and I'll talk about that just a little bit later. And I think what people don't always realize is that it's not only about the number restriction or the value restrictions. Even if you're doing a private placement, even if you're doing an offering under a private placement exemption, you do need to be mindful of certain advertising restrictions as well, which could make you inadvertently trigger the private placement exemption. Then separate from that, if in the context of an STO, you're actually kind of managing third-party capital, you're doing that in the context of a full-blown asset management framework, then you do need to worry about fund management, asset management laws as well, which, just on first principles would require you to register as an investment manager, unless, again, you fall within the exemption. Then there's also other kinds of laws that you need to think about in terms of, if you're kind of connecting investors to deals, effectively acting like a quasi investment banker, then again, there's a separate registration regime that could apply. So again, you need to make sure that you sort of fall within the exemptions. So then in the context of a particular deal, you just need to be very clear on what those exemptions are. In a securities law context, make sure you fall within them, whether it's a number, threshold, whether it's by category of investor. And do bear in mind, like I said, that even if you do that, you might still need to have some mandatory disclosures in your document. From an asset management regulation perspective, there are certain exemptions available if your underlying asset itself is not what is considered a regulated product by an investor. And I get asked a lot of questions, particularly in relation to real estate and even managing crypto in Singapore, where the prevailing understanding is that those are not capital markets products. But then again, there are other sort of pitfalls to be aware of. And I think Arvinder kind of touch upon that. The tax exemptions, as an example, sometimes don't kind of track through, even though you kind of don't need to be licensed, but you don't kind of get the benefit of tax exemptions if you're not kind of a licensed fund. The other point to be aware of is just a practical one, particularly if you're dealing with high deal volumes, large deal sizes, then sometimes investors would prefer that you be licensed from their internal risk management perspective as well. And even if you are exempt, that doesn't mean that it comes without conditions. So, there's just some sort of nuances to be aware of from that perspective as well. In certain countries in Asia, for example, Thailand, there's actually a bespoke digital assets law. And I think there's a huge debate, whether that's actually the right approach. In places like Singapore and Hong Kong, you kind of, if you're doing a security token offering, you're just meant to fall within the existing capital markets framework, but as Arvinder talked about, that's not necessarily the right, doesn't always give you the right result. But then on the other hand, if you do have a bespoke digital assets law, that covers certain specific types of digital assets or certain specific types of activities, you have that in places like the UAE as well. There's a specialist regime which applies even if you're just doing a regular investment product, but just represented by digital tokens. So the advantage is that, some of these sort of, pitfalls of using applying a pre-existing regime have already been thought through. But I think the challenge that I found is, because there isn't a whole sort of track record of many issuances built in, there isn't kind of a clear understanding on how certain provisions will be interpreted under these new laws. There's not actually been the level of activity that would be expected under these new laws. So, it's not always, again, a one-size-fits-all approach, depending on what the structure of your deal is. So the other thing to just kind of think about, and again, it's if you're doing a capital markets issuance, by definition, it is going to have a cross-border element of some form. So you do need to be aware of regulatory hot topics on an international scale as well. The US SEC has, of course, been, going gangbusters after everybody and anybody with a nexus to digital assets. So you just need to kind of be mindful of that. They're very focused on liability of intermediaries. Indeed, under traditional capital markets law, the focus was always on pinning 10b5 liability on investment banks. And suddenly you have this whole digital token industry, which is all about not having intermediaries. So they're kind of a little bit trying to find people who are involved in the larger deal-making process to kind of pin this responsibility on. So I think you do need to be particularly careful as an intermediary. And they certainly have been going very firmly after, marketing process in the form of influencers and such like. Again, these are just sort of trends we see in global capital markets worldwide, just kind of drawing on recent incidents, events, regulatory thinking, certainly to the extent that your deal involves related party transactions of different kinds, be it sort of at the actual structuring asset level or be it kind of at the investor level. There's going to be a lot of questions on that. Certainly, there's a huge focus on AML, KYC on investors, and there's also funds, obviously a very, very hot topic in Singapore. And to the extent you're accepting payments in cryptocurrency, then I think, again, that kind of becomes a flashpoint in many countries where, crypto is a kind of not accepted, and crypto and digital assets tend to be seen sort of interchangeably. So even if you're doing a non-crypto security token, you just need to be kind of careful about the messaging and the narrative, and be prepared that in certain emerging markets, there'll be kind of an education process involved as well. The other thing to just be aware of, I mean, obviously there's a growing trend towards investor protection in the STO space. It's new and exciting, but some are like, this is kind of the beginning of the end. So we see, for example, in Thailand as well, knowledge-based tests, whether investors really know what they're buying. There's some additional health warnings that need to go in if you're doing anything relating to virtual assets in several of the more advanced Asian jurisdictions as well. And then again, this isn't so much coming from the digital assets world, but just from the regular capital markets world now, that we've kind of seen a very interesting shift in macroeconomic conditions, driven by geopolitical events. And otherwise, I think there's just going to be more of a focus on, the same old things, but now kind of more, it's more important than before. Use of proceeds, what exactly are the rights of token holders, and particularly for asset-backed tokens, a token by itself doesn't mean anything. The important thing is what is the exact bundle of rights that it represents. So asset-specific disclosure, track record of deal principles. I think we can all expect that the next few big blowouts from an international capital markets perspective are going to be around that point. Cross-border insolvencies, I think, again, a very important focus for regulators. Some of the adverse publicity has, of course, kind of come from the whole kind of crypto meltdown, but I think it's increasingly clear that debt restructuring and insolvencies, how they actually play out in a cross-border context is not always in accordance with, how we think it will play out, and that can obviously affect recoveries and returns for token holders. So I think there's just going to be more focus on the what if meltdown events. So I think, I've just got sort of very little time left, so I'm not kind of going to go to the details, but I think these slides will be shared afterwards. I mean, just in terms of the documentation framework, I do get a lot of questions on that, so I've put in some notes for everybody in there. I think, again, there is a little bit of a tendency sometimes for market participants to be caught up with it, this all being new age, but I think we sometimes forget that there's lots of old school traditional capital markets protections that have been built in over time. One of the most important documents you can actually use to protect yourself is the simple document called publicity guidelines. It's something everybody within your team should actually have, so that you're all kind of speaking to the same document in terms of how you market the deal. And that can actually help avoid a lot of liability for issuers and intermediaries as well. So I think those are just sort of, some of those tried and tested tools from the traditional capital market space that can be easily deployed here. So I'll stop there and hand over back to the DigiShares team.
Thank you, Pooja, for a great presentation that I hope helped to clarify out of sort of how to tokenize in out of Singapore as a jurisdiction in Southeast Asia. We don't have any questions at this stage, but I will, if any shows up, I will save them for the panel at the end. Otherwise, we can move to the next speaker, which is Mr. Henry Yu from L&Y Law Office. He is the founder and principal partner of L&Y Law Office and Henry Yu and Associates. His areas of expertise include blockchain, commercial law, corporate and commercial transactions, and foreign and cross-border investments, and he has qualified as a certified financial technologist. Apart from his admission in Hong Kong and England and Wales, he has also been admitted as a solicitor of Greater Bay Area, People's Republic of China. Prior to that, Mr. Yu worked as an executive director and deputy head of legal counsel of ICBC International Holdings Limited, which is the investment banking arm of Industrial and Commercial Bank of China, one of the largest banks in the world. Welcome, Henry. I hope you are ready on your side. Nice to have you here as a speaker. Looking forward to your presentation.
Yeah, let's share the presentation slides first.
Yep.
Yeah, so we do the sharing.
Share screen, yeah.
Yeah, share screen. Can you see it now, or?
We see, I think, the background of your screen. It's a nice mountain.
The mountain only?
Yeah. Maybe you should stop sharing again and then sharing just, yeah, I see PowerPoint now. But just, yeah, yes. Then I think if you make it full screen now, yeah, then it works. Thank you.
Okay, yeah, I understand like we have only 15 minutes, right? Yeah. So I'm not going to go through everything, but hopefully I can give a brief, good overview of the Hong Kong regulations on the STO and the tokenized investment products. So we should jump. Thanks for introductions, right? And I'm not going to go through my background any further. Of course, as a general disclaimer, this PowerPoint just do not constitute any legal advice and just for general information only. So for the purpose today, I'm just going to give a very brief overview of the virtual asset regulations in Hong Kong. And then I will briefly touch on the new BSP licensing regime in Hong Kong. And then we'll focus on the STO offering. And then, of course, I'll see whether there's any Q&A. So just a very brief intro of the history of the regulation of virtual assets in Hong Kong. As far as Hong Kong is concerned, everything started back in 2018. So that's the first time when the SFC, the Securities and Futures Commission, which is the relevant regulator for virtual assets, start to look into the, of course, the crypto assets. And basically in 2019, they came up with the position paper, the opt-in regime for the VA trading platform. That's the first time when they say, okay, for all the crypto exchanges in the world, you may apply for the license in Hong Kong, but just because we are, if you remember correctly, Hong Kong was quite different by then, and that was quite difficult to pass legislation in Hong Kong. And therefore, they just use an innovative approach, that's what they call the opt-in approach. So it's voluntary for the crypto exchange to apply for the license, but it's not mandatory, so to speak. So therefore, if you may remember, there have been lots of different crypto exchanges, including some of the biggest exchanges, or even including FTX was in Hong Kong during this time, despite the opt-in regime. So everything changed, I would say, end of last year and this year. So we now, because they have the Legislative Council in Hong Kong is now quite different, and it's a lot easier to pass the law. So they recently passed in 2022, they passed the VASP, the Virtual Asset Service Provider License regime in Hong Kong. And the major change is that it will now become mandatory to apply for a license if you want to operate or advertise your crypto exchange in Hong Kong. It become mandatory. It become mandatory after the 1st of June 2023. So why is that relevant? The VSP license, I've already touched on that. And in Hong Kong, the other relevant licenses, as far as the STOs are concerned, tokenization is concerned, mainly will be the Type 1, Type 4, and Type 7, Type 9. So for any of the crypto exchange or virtual asset exchange, to touch on to handle the virtual assets or tokenized assets, that they would need both Type 7 and VSP. That's for the exchange. If you want to distribute securities tokens, then you will need Type 1. If you need to advise, so you're advising your clients whether to buy certain securities tokens or not, then you will need Type 4. And if you want to run a fund to hold or invest in securities tokens, then you will need Type 9. So I would briefly discuss and explain the VSP license regime. This is very important. The regime in Hong Kong, this is the first time, one of the significant is that it's the first time for Hong Kong and the Hong Kong regulators to define what is virtual assets. So if you look at that's the definitions, right? That's the definition of virtual assets in our anti-money laundering ordinance. That's the relevant ordinance for the VSP regime. So it includes everything which is a cryptographically secure digital representation of value, which is a unit of account or a store of economic value, and which is also used as a medium of exchange accepted by the public, which could be payments for goods or services, discharge of that, or investment, right? So that will include not just only the securities tokens, that will also include Bitcoin and Ethereum, which normally we consider as utility tokens, right? So every of the tokens to be traded on the exchange will fall within the definition of virtual assets. Some people may ask whether DAO, the DAO tokens, decentralized autonomous organization tokens, would fall within this definition, and the answer is yes. If you look at the definition of B, provide rights, eligibility, or access to vote on the management, administration, or governance of the affairs in connection with or to vote any change of the terms of any arrangement, that actually is targeting the DAO tokens as well. So that will fall within our definition of virtual assets. But there are certain, of course, exclusions. So, for example, the CBDC will be excluded. If it's just a pure the securities futures contract, that would not be a VSP, but that will still be the SFC, the Type 7 regime, or the stable coin. The stable coin will be governed separately under a different regime. by Hong Kong AMA, not the SFC. But however, for the P2P or the OTC market, that would or the ATM or the other institution offering the lending services, that would fall outside the VASP regime. So therefore, not be regarded as a VA exchange so far, as far as the Hong Kong law is concerned. So that will be if you want to apply for the VASP license in Hong Kong to run the crypto exchange, you will have to fall within you have to satisfy some of the key requirements, including some of the key and properness, adequate financial resources, knowledge and experience, and all this. I think that the key theme in here is that you have to two things. One is to make sure that to avoid the money laundering. That's the first thing. The second thing is that you have to offer investor protections, including protecting the assets, the virtual assets, and also protecting to make sure the relevant investor has the adequate knowledge and experience and the financial resources to invest in the virtual assets, whether it's securities tokens or the utility tokens. So they also require the crypto exchange in Hong Kong to set out explicitly certain criteria for the admission of virtual assets, no matter whether it's utility tokens or securities tokens, right? So for any of these security tokens to be listed on the Hong Kong licensed virtual exchange, they would need to look at, as an exchange, they have to do due diligence on the background of the security tokens. They have to look at the background of the management, the regulatory status in Hong Kong, the supply, demand, maturity, liquidity, and market cap of the securities tokens. They have to look at the technical aspect behind the tokens, and they look at the development so far of the securities tokens, and they also have to review the marketing material or the other legal risks as well. And so far, they have made very explicit the security tokens can only be offered in Hong Kong to the professional investors only. For professional investor, as you may know, that is for individual, they need to have a net worth of about 8 million Hong Kong dollar, which is roughly $1 million US. For corporate, that will be 40 million Hong Kong dollars. So far, if any of you want to list securities tokens in Hong Kong, you have only two choices. One is OSL, the other one is Hashkey. So right now, just only two of them have obtained the license, full license in Hong Kong to trade securities tokens. Having said that, it's already other than OSL and Hashkey, there are 4 others are in the pipeline. You can see Hong Kong VX, they have already got the approval in principle, but that's still waiting for the full approval yet. And the other 3 is Hong Kong BitX, Victory FinTech, and Hong Kong BGE. These are the other 3 which have already submitted their application but have not been approved yet. And there are also other crypto exchanges which have already indicate their intention to apply for the exchange license in Hong Kong, including Huobi, OKX, BitMax, Hong Kong as well. So so far these are the only choices that you have if you want to list the securities tokens in Hong Kong. And as I just mentioned, if you want to distribute the securities tokens in Hong Kong, right, then you would need a certain distributor or some asset manager to help. And I list out because in Hong Kong, not every broker-dealer can handle securities tokens. Only the one who have uplift the license and told the SFC to get the approval to handle the securities tokens can do so. And I've listed out only 11 of those so far who have obtained the relevant approval from the SFC to obtain the licenses to handle the virtual assets, including the securities tokens. So some of the name you may see is Hashkey. So Hashkey is so Hashkey Capital is related to the Hashkey Group, and of course the New Huo, right, is related to Huobi. So I will jump to the part 3, which is the securities token offering. So as far as the Hong Kong is concerned, securities tokens fall of course, we need to look at this definition of securities, which is defined in the Schedule 1 of the SFO. That will include shares, stocks, and also include bonds, notes, and also the collective investment scheme, which is very similar to the Howey test in the US. And also that would include structured products offered to the public. And as you may know, this is a key theme in Hong Kong right now. The government is pushing very hard for the tokenizations of RWA, the real world assets, including other treasury bills, golds, or real estate or art, and collectibles as well. The government, including the regulator, really want to push hard on this front. Of course, the other speakers already covered, right, some of the key advantages of STO. And I think the one important feature is that is 24/7 tradable, and the other thing is programmable. And of course, as far as the STO is concerned, we have done quite a few STO in the past few years. And then I would say, based on experience, I would think STO would do a very good bridge between the ICO and the IPO because there's a gap here in the funding. In the funding scene, and then so far as our experience, the cost I would think is a lot lower than an IPO. As you may know, a regular IPO for the main board that will cost 20 to 30 mil, but obviously doing the STO in Hong Kong, the cost wise will be a lot lower than that. And but I think one of the major I would say limitations so far is that we have certain lack of the distribution channel in Hong Kong. And recently you may have heard there's a company called the CS Pro in Hong Kong, which have obtained the license in Hong Kong to distribute. Their business focus is to distribute the STO. But so far, this is a very good example, and there will be more company would uplift the license to focus on this area. The one of the things which I want to explain or elaborate on is that actually the SFC, our regulator, had recently issued a circular on the 2nd of November, very recently, right? So less than 2 weeks ago, particularly on tokenized investment products. So they issued the circular on tokenization of SFC authorized investment product, and also the circular on intermediaries engaging in tokenized securities related activities. So interestingly, in the eyes of our regulator SFC, they have distinguished two types of tokenized, I would say, securities tokens, right? One is the tokenized securities. One is called the digital securities. So I will elaborate on the tokenized securities, right? In the eyes of the SFC, right? By their definition, tokenized securities only means the digital securities which represent the traditional financial instruments. So like the tokenized bonds or the tokenized funds, right? So in their eyes, right, the bond is still a bond, but they just put a wrapper over the bond. So far as the bond is concerned, it is still the bond, but instead of issuing the bond certificate in paper form, you would now have a token to represent the bond certificate. But other than that, everything is exactly the same. You are still supposed to stick to the traditional system like the Euroclear, or you are still stick to using the same banks as before. So that's in their eyes is the tokenized securities, very traditional, but the only difference is using a token instead of paper. And then there's a wider definition of what they see is the digital securities, right? So they see digital security it means all the security within the meaning of the SFO that would include but not limited to tokenized securities, right? And the nature of the digital securities could include the blockchain native tokens, which do not have any link to extrinsic rights or assets. And that could be bespoke, could be novel, and could be very complicated as well. So in their eyes, some of the examples would be, let's say, tokenize the fractional interest in a real world assets, right? Let's say we tokenize the building or tokenize the artwork like Mona Lisa, right? that would fall within the definition of digital securities, but not necessarily be tokenized securities, right? Or if you have like if you have a CIS, collective investment scheme, or you have a profit sharing scheme, right? You tokenize that. That will be a digital securities, but not necessarily a tokenized securities. But why do they have to make the distinctions, right? So in their eyes of the SFCs, right? Tokenized securities are basically fundamentally still the same traditional financial instruments, right? But just only with a tokenization wrapper. So they would think all the existing legal and regulatory requirements would just be applicable to those would apply. So the same thing, the same product, the same risk, the same rules, right? In the words. So that so if you just only doing the tokenized securities, right? You just only need to have a additional comply with the additional requirement to issue the key risk factors to address some new key risks, new risks associated with the tokenization. For example, the ownership risk. So whether it's safe for the token to record the ownership or the transfer of the tokens, whether it's on-chain or off-chain, or whether that will give you the settlement finality, right? That's the thing they think the issuer should make it clear. Also, they think there will be some technical risk, technology risk as well, whether the DLT network behind the tokenized securities will be robust enough, whether there will be any potential forking, or whether there will potential risk of network outages, that's or the potential loss of private key, loss of the private key. That's something that you should highlight to investors as well. And the lastly is, of course, the cyber security risk, the cyber attack, hacking, and authorized transfer, right? So other than that, they think they exactly the same rules would apply, whether to the same product. But however, so far as the digital security is concerned, they would say if it's in a bearer form, is on a public permission network, they are considered to be very high risk. Because due to the anonymity and the openness to public access and a lack of centralized control, there's something not yet being approved by the SFC so far. So you can see like some of the, because when we issue the SFC, issue the tokenized securities, right? You still need the endorsement by the SFC indirectly through the exchanges, right? So for example, there's some of the key requirements that you need to be take care of. For example, the issuers, they make it very clear, need to be responsible for the overall management and the operation of the tokenization arrangement. And then the platform concerned, the distributor would have to do due diligence and assessment regarding the tokenizations. And then you have to look at also do due diligence on the manpower and the expertise, and do you have to make sufficient disclosure of the information. And at last, of course, you have to make sure the end buyer, i.e. the investors, are suitable for your tokenized securities. And at this stage, because it's still the early stage, you are still encouraged to seek prior consultation and approval by the SFC. So one thing is a lot of those securities tokens right now will be classified as the complex products in the eyes of the SFC. So complex product has a particular definition. In Hong Kong, complex models means investment products whose terms, features, and risks are not reasonably likely to be understood by retail investors because of their complex structure, right? So in order to determine whether something is a complex product, you have to look at the 6 factors at least to determine whether the securities tokens is the complex products, right? I'm not going to, of course, set out all, you can read yourself here, but of course, like, for example, if the investment product is derivative products, if the secondary market is not yet available for the trading and all this, there's some indicator, a very good indicator that will be considered as a complex product. So, so if it's a complex product, as we just mentioned, that would unlikely to be, that would be available only to professional investors only, and retail is unlikely to be able to purchase those. And then, of course, for if someone want to issue digital securities in Hong Kong, they have to take care at least of the two major requirements, right? One is to, as I just mentioned before, you need an authorization by the SFC under the Part 14 of the SFO. And the other thing is the prospectus requirement, because so if you use a tokenized shares and a tokenized bonds, right, you may need to write a prospectus under the Hong Kong law, the Companies and Financial Miscellaneous Provision Ordinance. So right now, the SFC say, because it's still new and in Hong Kong, they will encourage the tokenized securities authorized investment product will only be offered and sold by way of primary offering. They do not encourage at this stage to have secondary trading. Right now, due to concern, as they said, the token ownership records, the regular trading infrastructure, So right now, they want to test it out by having the primary dealing only, without the secondary trading at this stage. So interestingly, some of the, I would say the new development in Hong Kong, right? The OSL, one of the two licensed crypto exchange in Hong Kong, recently on the 1st of November, they made a joint announcement with Harvest to say that they have already made a submission to SFC to of a proposal for the offer of tokenized retail fund products. So if that is approved finally by the SFC, right, that will be one of the first kind where the fund product, the retail fund product, could be offered to the retail. But that's something is still a proposal, is not yet approved in anyhow by the SFC. So, but that's something that could be foreseen in the near future. And secondly, in Hong Kong, recently the Taiji Capital, right? They have recently made an announcement in September 2023. They have launched a real estate STO, which is called the Prince Token, and they are only for sale to and distribute to professional investors only. So the Prince Token is actually a closed-end fund managed by Pioneer Asset Management Limited, and which is a subsidiary of the Taiji Capital. The fundraising target is 100 mil, and but the minimum investment size is only $1,000 according to them. So based on our understanding, is still on the fundraising stage. So, but the investors would be entitled by holding tokens to the annual distribution from the rental income or the future appreciation in the property value. But the entire sort of the token is still subject to the regulatory approval by the SFC. The other interesting, I would say, project in Hong Kong is the FinBlocks Open Eden project, which is a tokenized of the US Treasury bills. So in June 2023 this year, FinBlocks, which is a Hong Kong-based crypto investment platform, they have announced the launch of the tokenized right to the T-bills. So the Open Eden's T-bills are backed one-to-one by the US Treasury securities, the USDC and US dollars, right? With the on-chain proof through the Open Eden T-bill vault, with the integration with the chain link. So FinBlocks will be acting as the intermediary and invest in the Open Eden T-bill tokens, and then in turn, the FinBlocks will pass on the yield to users by issuing their own TBU tokens. So they use a dual token structure, right? One is the T-bill tokens, one is the T-bill yield token. And by holding the TBU tokens, you can receive the yield of 4.7% per annum. And also, same as before, that is only available to professional investors or accredited investors only. I would say these are some of the other, I would say, the STO potentially possible, whether in Hong Kong or overseas, right? So one is I would say that some of the interesting one I would just highly select is let's say Canadix is a Japanese real estate fund. So they issue a STO based on an onsen hotel in Sapporo. So they issue the amount is $25 million. They issue it in May earlier this year. But they use the platform by the Mitsubishi UFJ group and the underwriter. They have an underwriter of the Daiwa securities and all that. And the characteristic of the security tokens is interestingly, they have attached utility tokens, right? So the security token is basically backed by the hotel, but interestingly, they can also redeem the utility tokens and exchange for certain souvenirs on site when they go to the hotel of up to $14 US. So there's so with the security token, they also have a utility token. The other one I think we could highlight is also an Canadian one, but it's a Japanese real estate, also the same Japanese real estate fund, but is in relation to a logistic facility. They raised another $45 US in August this year, using the same platform, but the return is basically the revenue, the rental revenue. So by the holding the tokens, you'll be able to enjoy the rental revenue from this logistic facility. And of course, in the future, the asset manager will also arrange for the sale of these logistic facility, so that at the end of the investment period, if they be able to sell this facility, there will be an upside for the token holder. And the last one, which I share, I think that's something we could foresee in Hong Kong as well, is so in the entertainment industry. There's the Cubics, digital assets. That's the issue. That the token is called the Destiny tokens, right? So they have 3 tokens. So one is called the I am glad token. The other one is I am delighted tokens. The third one is I am happy tokens, right? And 3 of them combined is called the Destiny tokens, right? So for the holders of all 3 Destiny tokens would receive a fixed return of 2.99% per annum. But however, there's an upside. If the movie revenue reach 1 billion baht in Thailand, then there will be additional bonus of 2.01% per year. So that will be paid to the token holder. So that will be add up to 5% per annum. And also, the Destiny tokens would have certain utilities and privilege. You will be entitled to special edition T-shirt and postcard, and also special access to the premiere screening or the movie ticket discounts and digital posters and all those. So I think in the future, the STO, I think the one advantage over the traditional IPO is that you could be very innovative, right? You can, other than just a security token with the financial return, you can also combine certain utility and privileges in your token as well.
Are you getting close to the end?
Yeah, so that's all I have, and yeah, I think the time is certainly very limited. And if you have any further information, or have any queries, feel free to reach out.
Thank you. It was a very interesting presentation, actually. I have a few questions myself. So we are a tech provider, of course. I guess we don't need to have any of the SFC licenses, right? It would more sort of precisely be the clients that would need that, right?
Okay, that would normally is the marketing or the trading. So if you just a tech provider, you don't need a license. But if you are, let's say, as I just mentioned, if you are a trading platform, is if an exchange, then you need a license. Or if you are distributing the security tokens in Hong Kong or marketing the security tokens in Hong Kong, then you will need a license.
Yeah, I also like the legislation around this separation between tokenized instruments and tokenized securities, I guess you called it, right? I think that's a great way of doing it. So I guess a tokenized share, a tokenized equity would also be viewed as a normal share, a normal equity, right?
Exactly. What they try to say is that there are certain products where a very sort of the vanilla product, right? So a bond is a bond, a share is a share, right? Whether you write it in a piece of paper, whether you write it in email, or whether you write it in a piece in the token, it should still be the share or the same as the fund or the bond. So they will try to distinguish that's the vanilla product, which should be just be a tokenized securities, so that the same rules should apply. So that would distinguish themselves with the more innovative one, which they will call the digital securities, which will be more a complex product.
Yeah, I think that's actually a really good way of doing it.
Yeah.
All right. Thank you very much.
Okay.
We will move to the next speaker. The next speaker is Joe Lin from Citadao. Joel is a Singapore-based contributor to Citadao, marketplace for tokenized real estate. He was previously an investment director at a private equity fund. Prior to Citadao, he was with CBRE, UBS, and CBRE. He holds a master's in real estate from the National University of Singapore. Looking forward to hear your presentation, Joel. So hopefully you can share and take over the screen.
Thank you, Claus. I can't share. I need Henry to unshare first.
Right.
Okay.
Okay, got it.
Yep.
Yes, good now. Thank you. Hi everyone. So my name is Joel, and I believe that the panel of lawyers here have given a very comprehensive introduction of the different structure in tokenization. I'm here probably to share a little bit more from a project perspective. The risk of real estate tokenization, actually not only in Southeast Asia, but globally. So my name, so as introduced by Claus, I previously worked at UBS Investment Bank, CapitaLand, CBRE. Today I'm a contributor at Citadao. So Citadao is a DAO. Basically, it's an unstructured work environment focusing on gig economy. And tokenization as a whole storyline is actually not new. If you look at it, tokenization has been around for at least a decade. It started off with the US dollar, which is the most commonly tokenized asset today. And I would like to talk about something very important here when it comes to risk of tokenization, which is the concept of de-tokenization. Now, we believe that de-tokenization matters a lot when we talk about tokenization. Interestingly, very few people have been talking about it. But if you look at it, the most successful case today is actually the USDC, as well as the USDT, whereby if we deposit $1 fiat inside the bank account, we get one token that allow us to redeem back the $1 in the bank account. If you look at it, this has over time maintained its stability of the token value. But there's this very famous guy in this picture called Do Kwon. You may or may not have heard of him. He's famous because he went out selling the concept of US stablecoin, US dollar stablecoin, UST. He calls it tokenization, it isn't tokenization, because again, as Henry has pointed out, it's a complex structure, digital security. What happened here is that the US token is supposed to be redeemable for the US dollar via another token called Luna. But when the Luna price fell to zero, investors realized that they can no longer redeem the UST for $1. They panicked sell and the UST fell to zero. And this is the result of what happens when we tokenize without considering avenue for de-tokenization. During the same period, USDC, USDP, and USDT, all stable coins backed one-to-one, or rather backed by fiat currencies, they claim, in the bank account, were able to facilitate redemption. So even though there was panic, fear coming in during the collapse of Terra Luna and Do Kwon, you realize that the other stable coins, the other tokenized US dollar tokens help their value because simply investors realize that, hey, you know what, if I were to redeem $1, one US dollar token for the US dollar, I can always do so. And this brings us to the first point of one of the risks of tokenization. Now, interestingly, everybody have been a lot of projects have been talking about tokenization. Very few projects actually explain how it can be de-tokenized, how the tokens can be used to redeem the underlying asset. In our case, we have actually set this as the core fundamental of our project, in the sense that we believe that de-tokenization is a fundamental principle in tokenization in order for any kind of tokens, be it what it represents, to maintain its value. In our case, it's real estate tokens. So for example, in our case, it's possible to actually use the real estate token to eventually redeem the title deed or the long-term lease of the underlying real estate at will. And this is very important. It should be at will anytime the investors want to, and not when the project say you can do so. Otherwise, you result in a bank run situation that brought down the fall of Do Kwon's Terra and Luna project. So having said this, let's talk about tokenization. I've been in the space for close to a decade, and okay, not close to a decade, about 7 years. And in that 7 years, I've heard many stories back during my institutional days at CapitaLand, at CBOE, at UBS, of many kind of tokenization assets out there. The most common one is obviously, and most successful one is obviously US dollar. The first attempt at tokenization was gold. And then there were many attempts to tokenize real estate rents, stocks, bonds, profits, Bitcoin, so on and so forth. There were even some that were talking about tokenizing spouse. That's interesting. But the true measure of tokenization, when anybody comes out with the concept of tokenization, and this is particularly interesting in Southeast Asia, because in Southeast Asia, everybody seems to be willing to tokenize every single thing, including spouse, right? So the question here is, what can we tokenize? What are safe to tokenize? What are the risks of tokenization? In my years in tokenization, I've come to categorize four key category risks: counterparty risk, liquidity risk, regulatory risk, and infrastructure risk. Starting off with counterparty risk, the most common understanding of counterparty risk is actually Silicon Valley Bank and Circle. What I call direct counterparty risk and indirect counterparty risk. Now, interestingly, this is a concept that very few have even broached, or very few people actually in the tokenization space seems to understand, despite the many intermediaries and many trustees, companies involved. Who are your direct counterparty? Who are your indirect counterparty? The case of Circle USDC, when Silicon Valley Bank collapsed, you realize that Circle USDC stablecoin actually dropped by more than 20%. Now that's a company that right through the Terra Luna Do Kwon collapse, but was challenged during a seemingly irrelevant Silicon Valley Bank collapse. And the reason is because when they announced that the bulk of their deposit, their fiat deposit, the dollar is held with the US dollar bank, with the Silicon Valley Bank, investors realize that they have to look through the counterparty that they are dealing with. Not just Circle that they have to worry about now, but they have to worry about Silicon Valley Bank, where the US dollar that Circle keeps is held at. And they started to realize that if Circle were to lose that deposit at Silicon Valley Bank, and thank goodness it didn't, but if it were to lose the deposit, the stablecoin would have lost its peg, it would have lost its value. And it led to FUD, it led to panic, and you see a major bank run over the weekend, precisely when Silicon Valley Bank announced the insolvency. The interesting part here is when Silicon Valley Bank announced its insolvency, it announced the insolvency over the weekend, presumably to allow the regulators, to allow the government to try to save the bank. But if you look at Circle, because crypto is a evergreen product, it's trading 24/7, 365 days, every single second, the market instantly reacted to it, and the USDC, despite its claim to be able to redeem for $1, fell to as low as 80 cents before the government came out and said they're going to bail out Silicon Valley Bank, and then it returned its peg. So this is a very important part about tokenization, which I hope that everybody take note of, which is who are your counterparty? If we are tokenizing real estate, is it a development project under development, or is it a completed project? Because if it's a project under development, there are tons more counterparty here at stake, including the contractor, the construction companies, the developer, so on and so forth. So at this point in time, it's very important when pricing tokenize any kind of tokens to actually understand the counterparty risk. Otherwise, it will be quite painful making investment decision if you do not take into account the risk premium of indirect counterparty risk, who may be more risky. For example, a completed real estate project, which technically speaking, the counterparty risk is the government, versus a project under development where you will have a whole bunch of indirect counterparty risk stemming from the contractor all the way down to the developer. And moving to the next point, liquidity risk. What kind of liquidity risk are we talking about? Simply put, why did Silicon Valley Bank fail? Silicon Valley Bank had enough assets under management, assets on the book. But what happened was that when the US Treasury rate increased significantly above the deposit rate, the Silicon Valley Bank is able to pay its depositors. The depositors started rushing for the door. They started withdrawing US dollar to buy US Treasury. In the process, because the interest rate had gone up, the bulk of Silicon Valley Bank US Treasury holding at the lower interest rate were underwater. And because they have to fund liquidity, they have to find liquidity to fund the withdrawal from the depositors. It eventually resulted in them having to go for unrealized loss on their US Treasury position to realize losses, having to sell those US Treasuries at significant losses, which resulted in the collapse. This is a liquidity risk that that will challenge any tokenization project also, because if your tokenized assets, despite what it claims to have, is not liquid. Whenever you want to get cash in a hurry, whenever you want to liquidate the real estate tokens or the tokenized asset in a hurry, and you're unable to find a counterparty, the only way to find a counterparty quickly is to offer a deep discount, which will result in a significant deviation from the asset value. So again, it's important for any investors, in our case, real estate token investors, to appreciate liquidity of their tokens and always understand how that liquidity is actively secured. Liquidity don't magically drop from the sky. In order for liquidity to happen, you need to always have a counterparty. One way is to validate the liquidity on the secondary market before committing to any kind of tokenized investments. Otherwise, it's important to understand that what's the holding period. If there's any redemption feature, that will help. Otherwise, if there's no redemption feature, it's very important to know what's the holding period, where the active liquidity will be sourced for your exit. And third part, what is regulatory risk? We have been talking about regulations all the time. I think that's very important. But I would also like to highlight that if you look at all these entities here on the screen, how many of them are not regulated entities? The answer is all of them are regulated to a high standard, to a high degree. And if you look at them, they no longer exist today. So I think the burden of regulators, and this has been brought up in many meetings, which I have had also, many people have been saying that there's a high burden of regulators in the crypto space is unfair, because many projects, what they want to do is, when the projects are too complicated and investors do not understand what the projects are, they do not know what the risks are. Many projects, they end up leveraging the regulator's good name, and they go up to investors and tell them, say, look, we are regulated, okay, this is, and because of that, we are safe, so don't worry about it, just put your money with us and we promise you the return. So this is the return we offer you, okay? In terms of the risk, don't worry, you don't understand, that's fine, because this is smart money. All you have to care about is that the regulators are smart and they're regulated and they approve us, so we are safe. That is something that a lot of regulators are very wary about. MAS in Singapore experienced it the hard way. In fact, they have to come out during the Hodonot collapse to go on Reuters and actually mention that, yeah, do you know, when we regulate projects, we only regulate for anti-money laundering, FATF activities. They are not subjected to any risk-based capital or liquidity requirements, nor are they required to safeguard customer money or digital tokens from insolvency risk. Now, after the many crypto projects have blown up, regulators seems to realize that, look, maybe we should also start regulating the trustees and so on and so forth. But in so forth, many regulators, and you hear these complaints a lot, whereby projects claim that it's very hard to get licensing, regulators licensing, because regulators are smarter now. They realize that, look, it's very important when I put my good name besides the project to be able to ensure not only is it AML, FATF safe, that there's no market manipulation that affects the integrity and stability of the wider financial system. And maybe in the case of tokenization, proper trustees are around to ensure that the tokenized assets are safe. Having said that, and this is where regulators differ around the world. In the case of Singapore versus Hong Kong, real estate investments are actually not regulated. In fact, if you look at what MAS says explicitly over here, they says that if it manages a fund that invests solely in movable assets, which is real estate, or invest in investment holding companies whose sole purpose is to invest into real estate development projects, and only offered to accredited or institutional investors, they do not have to be regulated. This is very, very important because it shows that different regulators around the world have different opinion on different asset classes. Yeah. So in addressing regulatory risk, I guess it's very important for investors to understand regulations, perform the due diligence, and do not over-rely on regulators. Just because a project says that they are regulated, they are licensed, doesn't mean they are safe. They should be conducted. Due diligence for such projects should always be conducted as same as unregulated investment. And very importantly, understand what kind of activities are being regulated. Is it AML? Is it FATF? Is it custodianship? So on and so forth. Because most importantly, we all should know, as seen in the first slide, regulated platforms are not guaranteed protection from insolvency. You can still lose your money. So in this case, if we look at this scale of things again, what assets are safe to tokenize? In my opinion, US dollar, real estate, gold, bonds, anything that fulfill the four risk element that I mentioned earlier, and the ability to redeem the underlying asset with the asset token. For us at Citadao, we are in the real estate space because it has the deepest market size for tokenized assets. We are a group of 30 contributors spread across 7 countries with one common vision. Our common vision is that real estate globally is undervalued, and that's because it's very capital inefficient. It lacks accessibility, liquidity, and composability. We believe tokenization will solve this. If you look at it, the REITs were the first innovation to attempt to increase the value of real estate, and they were invented by investment bankers to basically bring larger real estate to the investor at better value to the vendors or the landlord or sellers. And REITs basically is basically a company that buys a whole bunch of property and lists the shares on the stock market, giving it better accessibility because it's fractionalized already, and liquidity because stock market have market makers. But if you think about it, who makes the most money out of this whole transaction? It's not the landlord only. It's not the investors. It's actually your exchange, your brokers, your market makers, or your intermediaries in between. Our vision is to take all those fees, return it to the token holders, to the REIT unit holders, so that they get better value for the better return for their tokens. And this is how we imagine the future of tokenization to be. In the traditional real estate, most investors will be looking at capital gains and rental income. We believe that tokenized real estate can provide investors with more source of revenue, capital gains, rental income, in this case, also trading fees and market making incentives, therefore resulting in better value for the real estate tokens than the underlying real estate itself. And we believe that because of this, real estate tokens will be more valuable than its underlying real estate. So this is basically how it works. We believe that by improving accessibility, liquidity, and composability, real estate in general will become more valuable. Our view of real estate tokens is very different from most projects' view. In fact, we do not view real estate tokens as security tokens. We view real estate tokens as utility tokens. And that's because of the way we structure them. In our case, we structure real estate tokens as utility tokens to buy out other real estate tokens to redeem the underlying title deed or long-term lease agreement, as well as the right to provide liquidity for the real estate tokens to earn reward. In our case, the real estate token do not represent any fractional ownership of the underlying real estate or the holding company, doesn't entitle you to the rental income. But by structuring it this way, we're able to generate better return on the real estate tokens than the underlying real estate itself and any kind of security tokens. In fact, we are able to secure liquidity to the tune of 80% of the asset value, which I'll show later on. So if you look at it, we see real estate tokens having been more liquid, being more accessible because they trade 24/7, 365 days, having the ability to redeem. You cannot redeem that with REITs. You're able to select your real estate instead of having to buy a portfolio of real estate with REITs. It has lower transaction fees because most of transaction fees we earn it, higher engagement and higher rewards, which we talk about in composability. So this example of the real estate token that has been tokenized by the project is a property in Singapore, a very small size property. It's about $600,000 only. And this is a proof of concept. And we look at the secondary market total pool details. It says 431,901 worth of liquidity available for people to trade 24/7, 365 on the DeFi exchange Uniswap. Most importantly, if you look at it, the capital gain on this real estate is 2.1%. The rental yield is about 4.1%. But over the last 12 months, because of the trading fees, market making fees, liquidity incentives, the fees that the large brokers, exchange institutions, majors have been earning, there's additional 44.5%, bringing the total return from the real estate token holders to 46.6%. This is the breakdown. Whereby it's a bit more complicated. I won't go into details here, but the gist of it is real estate token allow you to earn revenue from more sources, resulting in better returns.
May I ask, what's the LP rewards or the trading fees rewards and all that?
It's trading fees rewards plus the DAO tokens, which are pegged to Ethereum. So as Ethereum price goes up, you also earn.
So where would the rewards coming from, right? Because you say it doesn't own anything, it doesn't own any property or rental or anything, right? But all in sort of that's the 2.1% gain, but with a 44.5% LP reward.
Yes. So the LP reward consists of three things. The trading fees, which is split into the real estate token and the USDC, based on the bid-ask spread, as well as additional fees charged by Uniswap. That is given back to the token, the LP holders. And then on top of that, you also have your DAO tokens that are pegged to Ethereum, which is afforded as a additional return booster on the liquidity pool. So collectively, the price of everything generates higher returns for the real estate token holders. Now, if you look at it simply put, right, even if we don't consider anything else, right? We just consider let's say the trading fees come in as additional 1%, market making incentive coming as additional 0.5%. Instantly, you're already earning more than the actual real estate itself. Because
you say the one thing I don't understand, because you say the real estate token do not entitle you to the title or the rental, right? But here you say there's a capital gains or the rental.
Yes, that's a very good question. That's a very good question.
So because you said it's a token without any rights to redeem, just the right to redeem, but does not entitle you to anything.
It doesn't have the right to redeem also. You have to go through the buyout smart contract in order to redeem. Yeah.
So why would that be a capital gain and why would that be a rental when you say that's not tied to the title deed and not tied to the rental?
The rental income is used to buy and burn the real estate token.
So is the burning.
Yeah, the real estate token is a deflationary token.
Okay, so what you say is the capital gain and the rental income will be used to burn the token.
The rental income, yes, not the capital gain. Capital gain is a supply of demand and supply. It's a function of demand and supply.
It is a pure supply and demand.
Yes, equation.
Of the token itself.
Yes.
But it's not the capital gain in the same way as the traditional
Not
real
on the
estate.
underlying. Yes, correct.
So yeah, nothing to do with the token holders.
Yes. If you think about it, the REITs function the same way because the REITs, if you look at it, they always trade above book value, under book value. They never trade book value because of demand supply.
Understood, but it's different. It's a different concept because you still have a reference point, but whether you trade above or below is, of course, it's based on the liquidity and all that.
Correct.
But now you say it's a pure, but this supply demand is pure supply of demand of the token, but not a pure demand supply of the underlying asset.
Underlying, yes, correct.
And then you say the trading fees. Yeah, and then the trading fees.
Yes. So this is all on the Ethereum blockchain, it's public blockchain. I can give you the contract. You can go and take a look at all the trading fees, all the transactions that they place there. So it's
and then you would say that will be shared amongst the token holders.
No, not amongst the token holders, among those who provide liquidity. So anybody who participates in the liquidity pool, anybody who puts your USDC and the real estate token liquidity pool gets to share in this.
Additional, okay.
Yeah. So I know I'm running short on time, Claus.
Yeah.
Apologies for that. Let me just quickly go through. Basically, this is also the reason why the returns go up. Because landlords, they buy the Night token to list on the platform. There's also governance rights about being able to determine the liquidity incentive in the liquidity pool. But obviously the returns are much higher. So yeah, we are looking at reshaping the future of real estate. Thank you very much. Claus, over to you. Happy to take any questions after that in the Q&A.
Yeah, thank you very much. It was a great presentation. I think you really know what you're speaking about. You've done real estate tokenization for many years, right? And it's great project, great returns. Thanks for the questions, Henry. We'll skip on to the next speaker. I think we're running a bit short on time. So we will move to the last speaker, Chris Tran from the U2U Foundation. Chris is an experienced strategist, corporate team player, startup enthusiast with a passion for building businesses and challenging the status quo. He's got more than 12 years track record of defining new business strategies, launching new ventures, delivering operational impact, both as a business CEO and management consultant. He has handled an extensive full cycle driving deal execution from strategy to integration, taking care of public sector to enterprise, corporate and SME accounts. He's a motivational leader with demonstrated talent for managing massive cross-functional teams, regional experience, defining development strategies, motivated by challenges, advisory and managing investments and opportunities to learn. Welcome to Chris, last speaker. Looking forward to your presentation.
Yep. So thank you for all the speaker for a very good presentation. I think just to change the tone a little bit, I won't use the slide, but more like a quick brief about what I have observing in Southeast Asia so far. And I kind of like the questions that Henry kind of throwing out just now, because for me it's kind of tough to look at a real estate tokenization and really try to redefine how you're not a securities. It's really hard. It's going to be so hard to do so. I won't. I mean, again, first, I'm not representing a law firm like a lot of the speaker today. So more like from a project and crypto advisor for a lot of the blockchain project in the region. So my job is to help some of the project to find the right locations where they need to set up their fund and stuff like that. So very quickly, I think out of Southeast Asia right now, the two countries that seems the most ready for a lot of the product that we're mentioning today outside of Singapore, right? Outside of Singapore, probably going to be Thailand and Malaysia. And if you can research a little bit, actually right now in Thailand, there are a few real estate projects that they are combining with a few local crypto exchange. And for your information, so Thailand and Malaysia are the two countries that actually have regulated the crypto exchange business. So one of the way that the real estate developer are doing it right now is to combine with the local exchange to actually to put some of the, like real estate as part of the investment product on the platform itself. Malaysia, at the same time, have a very similar structure in terms of the regulations readiness. However, I don't see enough project coming out of Malaysia yet. And very interestingly, all of the tokens right now in Malaysia are still currently defined according to the last time that they push out the regulations. All tokens will be still considered as securities tokens, even though if it's utility tokens in a lot of the country how we define it for now. The two dark horse country, which is Vietnam and Indonesia, right now do not have much crypto regulations around the space, and that's where a lot of the gray projects are coming in. I think Indonesia have a few local tokenized real estate project as well, and Vietnam also. However, the scale of the Vietnam project will be much lesser if you compare to Indonesia. And the interesting point about, for Vietnam right now, I don't know if you guys know this, but crypto are not a legal tender in Vietnam. So basically, you should not use crypto to make payment for any commodities or product on the ground. It's against the law. That's why it's getting tricky in Vietnam, but depends on how you structure the project and the fundraising and put the project somewhere else outside of Vietnam, you may have a chance to do it. And there are a few other projects in Vietnam at the moment who do, tokenize and fractional investment without the crypto and without the blockchain. So we have a very big jewelry company in Vietnam, allowing people to buy fractional gold until it's adding up to like a smallest physical piece of gold. Then they can actually collecting the piece of gold as the store, for example. So very similar concept with tokenized asset, but without the existence of crypto and blockchain in that sense. So I guess all of the speaker and the all the experts have shared everything about Southeast Asia and Asia, especially Hong Kong. A lot of Hong Kong information and Singapore for today. I just want to share my very quick brief about some of those countries. Yeah, that's it, Claus.
Yeah, just a bit of add on, right? Indeed, a lot of Malaysian Vietnam projects have come to Hong Kong, set up an entity. As I just mentioned, because of Hong Kong regulations, they don't sell in Hong Kong, but then sell back to the Southeast Asia.
I would like to add on that too, Henry. So we were one of the first because during the ICO, gold rush, right? We were heading into Hong Kong during 2016 and 17 because that's where Hong Kong actually have a lot of the license that's suitable for a lot of the stuff that we do, especially when it comes to ICO and STO advisory. Yep. I forgot one piece of information. This is very interesting. So I think we probably one of the firms that did one of the earlier tokenized REIT on crypto in Southeast Asia, I think during 2018, and the location we set up probably gonna I think Pooja may aware of this. It's Labuan in Malaysia. So Labuan is actually one of the very underrated offshore jurisdiction that many crypto may not aware of, but they have a very active full-fledged of type of license that may suitable for a lot of the crypto business out there. And of course, it's very affordable as well compared to Singapore, if I have to say, and of course Hong Kong as well.
Yeah, totally agree. Yeah, for the recent STO projects I'm doing right now, actually is encouraging. Yeah, you sell in Hong Kong, sell to South Asia, and then trade in Labuan as well.
Yes.
All right, thank you, Chris. So that wraps up the presentations for today. We'll now go over to the panel discussion and have a few questions facilitated by me. And also to the participants, feel free to add your questions in the Q&A, and I will ask them to the people here. There are no open questions now, but I will just take a few of our own questions and ask to the panel. So I'm curious first, and thank you for the great presentations. Before we go into the questions here. So I'm curious what the people here feel about China's interest in the space and what's going to happen longer term with their sort of interaction with this space, with the space of tokenization, right? So I guess China is, of course, traditionally very negative towards crypto, but possibly more positive about tokenization. So does anyone have any insight on that?
Maybe I just kick off first, right? I would say, like, I always explain to the people, right? It's not that because tokenizations of blockchain and all this are bad, right? So that it's banned, right? It's not drugs, right? Or gambling and all that, right? It's just because it's so good that's why they want to do it themselves, right? They will issue their own CBDC and they have their own protocol and tokenization protocol as well. So the interesting thing is that therefore, as far as it's concerned, whether it's securities tokens or utility tokens, right? If you want to do that offering or secondary trading in China, it's totally banned. So I would highly sort of remind and warn of all the people here, right? That is highly risky, right? And need to be extremely cautious, right? If you want to tap into the sort of the PLC market. But one thing is that as I just mentioned, and Hong Kong have the new VSP sort of regime, right? It's highly costly so far, as you may have heard, and it's very restricted as well. But one of the interesting thing is why there's still sort of a queue of people who try to apply for the license is because the basically people see it as more as that's the testing ground for China. So like if anyone successfully, let's say, got the license and safely launch it for the next couple of years, there's a chance that they may open up the window for, let's say, the PLC people to come to Hong Kong to trade, or the vice versa is to allow the Hong Kong license exchange to open up the service to the Chinese people through Hong Kong. So something similar to Macau and the Macau casinos, the Macau casino license. Of course, that's all sort of predictions, and everyone could have their own view. But I always think yes, that's something that we could anticipate in the future. But interestingly, you will see some of even the real estate giants in China, including, you may have heard, the Greenland. They have already indicated interest to apply for the exchange license in Hong Kong. So it's a very similar logic as one of the speakers just mentioned, right? It's the real estate in Thailand, developer in China, in Thailand, also apply for the exchange platform in Thailand, right? I think there's the same logic here in Hong Kong as well.
Thank you. Any other comments?
Can I add in? Yes. So I think when we look at tokenized, and especially tokenized asset and an asset like gold, we have to be, I mean, as you know, like project startups, right? They have to really define why you're trying to do this, right? And I mean, if possible, don't complicate it, you know, like with crypto, right? Remove the crypto part away from it. For example, I think fractional investment for real estate and gold and asset really gonna work wonderful in some of the country like China. I mean, their digital readiness are exceptionally good, right? I mean, there's no need for crypto because the yen is already digital, for example. So if, you know, like a project only look out to basically onboard more user as a smaller scale of investment and basically allowing to create another, you know, like secondary or even third type of, you know, like a secondary market for trading these kind of assets. That's the best value of tokenized, you know, like asset in a way. And if you can do that without crypto, because some of the country are very sensitive with crypto, please just go ahead with, you know, blockchain technology, right? Do not add, you know, like unless you try to push in the tokens, because you want to get, you know, like economical gains from the token price and everything itself.
Yeah. Anyone else want to comment on this question? Nope. I was just wondering, so in principle, couldn't you do tokenization in China already today, just using the China's national digital currency and sort of treating it more as a fractionalization project? Wouldn't that be legal at this moment? Anyone knows?
No one would dare to do it.
No.
Right now.
I mean, I have been looking at it using Singapore as a bridge to gain access and then tokenizing out of Singapore instead. But to be honest, the way things work in China is that if you regardless of what the regulations say or the law say, right, if you're not on the same side as the party, things can change very fast.
Yeah.
Yeah, but I think the other thing, right, as you may know, in order to get the property rights in China, you have to get all the different licenses with the authorities, right? So
Yes.
you cannot purely just tokenize it without getting the approval from, there's a property rights certificate, right? And including all the others, there are 5 certificates that you need to get before you can prove you're titled in China to any of the properties. So, and none of them are on blockchain right now. Definitely not on Ethereum or Solana or Polygon and all that. So yeah, and I don't think there's any sort of intention of doing that. So yeah, I don't think that's, and RMB, that's another big question, right? They do not, there's no free flow of the RMB. So yeah, how to get the RMB in to buy the tokens, and then how to, even if you make a profit, how to get the RMB out.
All right, that's good. Another question here. So more general question, right? For maybe for some of the other speakers. What are the most promising use cases you see for tokenization in Southeast Asia, beyond real estate, perhaps? So what are sort of the most successful, interesting, notable use cases you see?
I have been working with a few projects in Vietnam and Thailand. So I think one of the prominent application would be around the loyalty space, Claus. So basically, you know, like the tokens or NFT will represent sort of a privilege that allowing them to have cross Web2 and Web3 experience. And right now we have seen, you know, like for example, in Thailand, the sandbox is pushing really hard into it. And in Vietnam, there are a few projects, for example, something called W3W, basically onboarding a lot of the Web2 brands like coffee shop, retail shop to issuing their, you know, like NFT loyalty membership on the Web3 space. And then just when they have these, you know, like token with them, they can have access into the series of benefits that can cross share between all of these players, for example.
Any other comments to this question?
One thing, yeah, just go ahead first.
Pooja?
I was going to say something I worked on a while ago now was tokenization related to a piece of fine art. And I think in Singapore, there have been some fine wine / whiskey related tokenizations of late as well.
Anyway, you had a comment?
Okay, yeah. So all that, I'll actually think because I work on the tokenization since 2018, I would think like tokenization of real estate is actually one of the hardest, not the easiest one to tackle. Yeah, and yeah, you can have the tokenized real estate fund, tokenized REITs, and all that, right? But if you want to have a very innovative one and all that, is not as easy. That's why I was like, as you can see, I was very interested in the token that we just mentioned, the Citadao, right, and all this. But yes, the other thing is loyalty points. Yeah, we are working on at least a couple of projects right now on loyalty points. The interesting thing is, which I've not highlighted obviously in my presentation, is that loyalty point is somehow exempted from our definition of the virtual assets in Hong Kong, and therefore you can expect like some of the people do not want to get the license and all that in Hong Kong, right? Because that's so costly and cumbersome, and therefore a lot of them are particularly loyalty points project we could expect to see in near future as well. Entertainment I think is a very good use case. As the movie, you may have noted that I think last year that quite a few projects in Hong Kong they use the NFT, and now there's some entertainment companies in Hong Kong working on in our Hong Kong, at least Hong Kong entertainment industry is trying to use the tokenization one way or other to fund the movies, fund the projects and else. definitely artwork is one of them. Artwork is a natural. Some of the art galleries in Hong Kong as well, they are trying to work on that, but that is a certain other thing out of the experience and all that, right? So what they call the blue chip artwork, they would not want to do the tokenizations, right? But and then we are targeting. You need to target some of the mid range. So I think $1 million, a million roughly to 5 million. That's a mid-range artwork will be most suitable for the real estate. For the RWA tokenizations. Yeah.
Movies is absolutely, I agree on that, because we did one for Vietnam last year too, Henry. Very success.
Yeah.
But of course, like the way that these tokens being set up for even for movies, it's so hard to really not define them almost like securities. It's because we still can do it because there are not enough regulations on the ground. But the moment regulation comes, there's a lot of paperwork need to go in before everything can be launched. Just one more product concept, and actually we have a project that working on it at the moment. So it's IP ownership for like AI patents. So because they are a platform that we have different like AI engineer contribute to like a sort of like a model altogether. So they will push out like a decentralized IP ownership to represent the ownership of the IP ownership altogether, and then commercialize on it. And we still decided, like where to put the base of the IP gonna be.
Where do you register it? That's the fun.
We still figuring that out right now, Henry.
Exactly, so, right? We've thought about that as well, but the hard part is the patent registration.
So most of the founder are in the US and Asia as well. And of course, the first country out of the way going to be the US already, because we will try to commercialize the IP as well. But I think we're gonna figure out the way to return the benefits to the investor. Maybe a little bit creative, like how Joe do it for Citadao, for example. But I think we kind of figured it out. Henry, actually, I want to catch up with you and even Pooja on a separate note, because I do run a law firm, crypto law firm for 5 years in Vietnam. And yes, there's a lot of activities heading to your ways right now, Singapore and Hong Kong. Yes.
Yeah, I'm sure. Yeah, that will be group to be set up for the speakers, right? Maybe afterwards.
Thank you very much. Any other comments on this question? Otherwise, we go to the next. So I think that at least the regulators in your countries are positive and constructive and want to move forward with tokenization, as opposed to what we see in other countries where they really don't care and just leave it lying. Do you see jurisdictional competition between your countries, Hong Kong, Singapore, Korea, and so on? Do you see that they compete in a way to allow companies to innovate as much as possible, or is that not really the way it's looking?
Actually,
go ahead.
Okay. Maybe I can just put in a quick 1 minute here, 30 seconds. So basically, from a project perspective, we go to whichever jurisdiction that provides the most efficient way to on-off ramp. That means convert crypto to fiat and fiat to crypto. Usually that requires licensing and regulations. The pathway that offers the least resistance attracts the most projects.
Yeah.
I think for Singapore, obviously it's still very forward-thinking and innovative and all of that, but I think it's just taking a little bit more cautious approach to digital assets, of late, just, given the sort of unfortunate events that have happened in the last few years in the crypto and digital asset space, which happen to have a nexus with Singapore.
Yeah. All right.
Well, maybe I can add on a little bit here. I think like actually that I don't see there will be any competition. I think there will be a lot of cooperations indeed. The reason why I say is that if I look at Hong Kong, right? What I would expect, I also mentioned is many times in different occasions, right? What I would expect is that in Hong Kong there will be two routes, two group of people, two routes. One is what they call the even for the Web3, what they call Web3 tokenization, right? One is the government-driven Web3 or government-driven tokenizations, right? So the other one will be the real-world decentralized tokenizations, right? You put it this way. So or decentralized Web3, right? So the reason why I say is that if you really look at, interestingly, if you have time, you can look at a paper called Bond Tokenizations issued by the Hong Kong Monetary Authority, which is the central bank in Hong Kong. Basically, if you look at that, right, the interesting, you don't have to go through the all like 30, 40 pages, right? But the gist of basically is that you can do the bond tokenizations all fine, and the Hong Kong government encourage it. However, the caveat is that you have to do it in the old way. I may have like sort of briefly touched on it if you remember. So they see it more as a tokenized securities. You can do all this, but in the same old way, except with the token wrapper. So you still have to stick to the same Euroclear. You have to stick to the same banks and all this, right? And you view it in terms of something as innovative as Citadao, or as innovative as the movies and all this, right? I don't think at this point of time or anytime near future that will be welcomed by the Hong Kong regulators, or that could be listed on the Hong Kong licensed crypto exchange at this point. So back to the reality is that, but still, I think most people want, right, is that the reality, I think the investor, they don't want the traditional product, because if they want to invest in traditional product, they can go where else? Back to the traditional market, right? They don't need to go to STO new market. So what we see is that a lot of people now is trying to come up with some new products, but however, they, as I mentioned, they will be set up in Hong Kong, but sell elsewhere out of Hong Kong and in the Southeast Asia. So and I think that will be, that's why I will see in that part there will be a lot of collaboration between the Hong Kong issuer or Hong Kong people with the other jurisdictions, which are more flexible. I'll put it this way.
Thank you. Next question. From our perspective, we view tokenization really as a new type of infrastructure, and not so much as a new type of security or financial services transaction system and so on. It's really just a new type of infrastructure where we can support securities transactions and processing in a more secure way that is transparent, secure, and make sure everything is locked and can be tracked and so on, and has much less chance of human error. So I hope that longer term regulators will see this point and view, as it was described earlier in the presentation here, that tokenized security or tokenized equity, tokenized bond is really just a digitized version of the same underlying security running on a more secure and more sort of high quality infrastructure, right? So do you think that the regulators are seeing this or agreeing to this point, or will do it longer term?
No, but on this point, right? Sorry for jumping in, but on this point, right? I believe the way I see it is that the regulators do see this point, do share this point. A lot of people, that will be more transparent, that will be quicker, that will be safer. But however, I think for the last one, the safer, okay, they will take it, but they will be more transparent or more, as you said, more quicker, right? The thing is it what the regulators really want? Or you really have to ask, is that what the bankers really want?
Yeah.
Because they, after all, the centralized bank are representative of the major banks, not for the investors. So my take out of all that, right, is that they are scared of it. They don't want to be more transparent. They don't want to be quick. So for example, I still remember years ago, I speak to the sort of Hong Kong Stock Exchange, right? You say, one of the blockchain technologies, all this, you can reduce to, because currently it's like T+2, reduce down to T+1 or T+0 or on all this, right? They say, actually, the current system can manage it as well. not without the blockchain, right? But the thing is, they don't want it. It's for policy reasons, that's for settlement reasons, right? Because, for example, for shorting and all this, right? And they cannot and do not want to see this to be as quick. So the fact that if you keep if we keep selling the same points to them, we say, but that's exactly the point that I don't want to endorse it.
Actually, on this note, right, I would like to further add on to what Henry shared in terms of the central bank's view. Our insights into this is that tokenization, as long as it's not regulated, ironically, okay, in my case, it poses a threat to the banking, systematic threat to the banking infrastructure, especially in today's market, because any investors that want to participate in any tokenization exercise will have to withdraw their fiat, their US dollar from the banks and deposit it into the tokenized platform. So that fragments liquidity. In the current market, whereby banks are desperate for liquidity, in the case of Silicon Valley Bank's example, right, the last thing they want is more liquidity leaving the system, not just for the US Treasury, but for tokenized or crypto assets, because that will collapse the banking system, the fractional banking system, completely. In fact, we have seen white papers, probably on a confidential basis, issued by the banking associations, appealing to the central banks to actually address this risk, which brings the point of regulation in the end. We think that in order for things to move ahead, at least at the institutional level, tokenization have to be regulated. In our case, we operate in an unregulated environment because we do not target retail investors, nor do we target institutional investors. We are predominantly operating within the professional investors AI space only. That's where we find our market for now. We believe that in order for wider adoption, institutional investors and retail investors have to come on board, in which case regulation is a very important part. Then the banks can actually recognize tokenized assets as AUM on their balance sheet, and then investors no longer have to withdraw cash from the banking system to actually participate in tokenized projects or tokenized assets. In this case, one of the leaders in this space is actually JP Morgan with the JP Morgan coin. It'll be interesting to see what happens as they develop that space.
Yeah, I agree. Any more comments on that? Otherwise, I think we'll just go to the last question, which is sort of ties nicely together with what you just said, Joel. So what do you see driving the market here? Do you see it being driven mostly by the institutional players or more by retail interest at this stage? I'm curious to hear your remarks to that.
Okay, from a project perspective, we do have challenges at the beginning, securing demand for any kind of tokenized assets, to be honest, even the real estate tokens. The reason, as what Henry mentioned, most investors will be like, if I can buy the underlying asset, why do I need the real estate tokens? Why do I need a token wrapper? What does it bring me? In our case, we test a few hypotheses. We tested higher returns, better returns. We tested better liquidity. We tested better transparency. All the stuff that existing tokenization projects are talking about. And the truth of the matter is, regardless of what you put out there, demand is still lacking because of the lack of regulatory clarity. Number one, many traditional investors are worried about what their rights positions are. And for the higher net worth officers, there's actually the concerns about tax implications, because many of the auditors, professionals are unable to advise them on their tax positions if they invest. And the last thing they want is to end up getting a huge tax bill, unexpected tax bill. So these are areas that I believe needs to be further improve on in terms of better regulatory clarity and professional understanding of tax implications before AIs and will be on board. In terms of institutional investors and eventually retail investors, we believe that it will have to be regulatory clarity, regulatory certainty, in fact, before they will come on board, because they have more to lose getting their license revoked or losing their existing customer base than coming on board a tokenized project, giving them maybe 100 million in revenue. Even that is very small compared to the scale of the revenue they are making in the traditional space. So they will probably require not just regulatory clarity, but regulatory certainty before they'll be willing to come on board.
Thank you. Maybe to clarify my question also a little bit, right? So in the US, we have seen BlackRock, KKR, JP Morgan, Citibank, and so on, really driving the space the last year or so, increasing the hype around the space. So do you see similar type financial institutions going into the area in Southeast Asia and sort of also pushing the space forward? Or maybe not so much.
So DBS have been DBS as a bank in Singapore has been pushing hard. Henry has given a lot of the Japanese banks, the Hong Kong banks, right? Yeah. So for example, candidates they are open, they're actively in this position, and they've been doing very well in this space because they have developed the credibility, the trust for the retail investors to invest in them as an institution. So I guess another important aspect here is trust, right? Trust can be built with track record, with credibility over time. So the Japanese banks have done that. The Singapore banks have done that. I believe that these institutions of trust will probably be the nexus for adoption, wider adoption in the space, pending their success.
All right. Thank you. I think we'll wrap it up, and I'll ask for if any of you want to make a final comment. Feel free. If there's something you feel should be said here towards the end, we'll leave time for that. Otherwise, we'll wrap up.
Yeah, maybe I just do first, right? So, so if any of you want to participate in this game, right, whether as an issuer or as a distributor or of exchange, right, most likely not, I think you will see the regulation will come in, and most likely not, they will see it as a securities token anyway. If you look at US, right, other than Bitcoin, Ethereum, right, who on earth could say that they can safely that or confidently that they are not securities tokens, right? But I think there's still many ways to, at least at this point in time, I think that the window, maybe for the next 2-3 years, you can still try to tokenize something RWA where with the minimal, I would say, regulatory burden, if you do correctly. But I see that there's a significant demand. But I think that of course, a lot of people are still expecting something like 28, 30x. That will be highly unlikely in the RWA world. But I think what you can see is that there will be some very interesting use case. So I would urge innovative use case of the tokens, right? Instead of just the traditional tokenized bonds or tokenized funds, right? I would urge try to come up with some new product, exciting product. Then I believe that there will be market for it.
Yeah. Thank you. I think we'll wrap it up then. Thank you very much for the great presentations today, and thank you for participating in the panel here. Looking forward to working with you guys in the future. Take care.